Welcome back to Talk Tickers, where your professional shortcut to earnings call intelligence.
That's right.
Today, we're diving deep into HEI's Q2 2025 earnings call. That's the big Hawaii-based utility and holding company.
Yeah, this call was held after hours, August 7th. Really critical one.
Absolutely critical. It was the first real look at how management's handling this massive pivot they need to make. You know, dealing with huge wildfire liabilities, getting financing sorted.
Yeah, exactly. And our focus today really is what we're calling AGI's race against the clock.
Race against the clock. I like that.
Because everything they did this quarter, I mean, everything, securing Act 258, selling assets, it was all about making this upcoming debt raise in Q1 2026 look as good and, frankly, as cheap as possible.
So they're trying to change their whole image, right? From this kind of risky, sprawling company to a stable, predictable utility.
Precisely. And time is definitely ticking on that.
Okay, so let's kick off with the results. The snapshot. Did they actually deliver on the numbers for the quarter?
Well, yeah, on the surface they did. The consolidated core EPS, that's non-GAAP, came in at SEER 1 under 20 cents.
Okay, 20 cents. And the street was looking for?
Consensus was around $18. So, a decent beat, about 11%. Revenue was solid, too, roughly $746.4 million.
So headline numbers looked pretty good. A beat?
A beat, yes. But, and this is the key thing, the market basically shrugged.
Really? Ignored the beat?
Pretty much. If you dig into the utility itself, the core net income there actually dipped slightly. $42 million versus about $43.9 million the year before.
Okay, so income down a bit. Why?
Management pointed to higher costs.
Yeah.
Makes sense, right?
Yeah.
Spending more on wildfire mitigation programs, insurance costs are way up.
Yeah.
It's just the new reality for them.
The cost of doing business in this new environment. So they beat the overall estimate by, what, tightening belts elsewhere?
Essentially, yeah.
Yeah.
And they did get some help from their ARM revenues. That's the annual revenue adjustment mechanism. Helps them recover certain costs faster.
Okay, so operations steady, but new costs are definitely biting into the utility's profit.
That's the picture. And the utility did push up a $10 million dividend to the holding company. Standard procedure there.
What do you say the market reaction was? Underwhelming.
Underwhelming is putting it mildly.
Yeah.
Muted to negative. The stock actually dropped the next day and on pretty heavy volume, too.
Wow. Okay, I'm surprised. If they beat, what spooked investors so much? Was it something in the guidance?
Wasn't really about Q2 performance itself. It's all about the balance sheet, the tension there.
Explain that. Balance sheet tension.
Yeah, the market is completely fixated on what's coming down the pike. The cost of capital they're going to face, the sheer size of the money they need for the wildfire settlement payments, plus all the planned infrastructure spending.
So fear about future dilution or just really high interest costs on new debt?
Both, potentially. They're basically betting that this required debt raise next year is going to hurt existing shareholders one way or another. The market's pricing in fear about future interest rates, not really rewarding the Q2 operational beat.
Got it. Which ties directly into what management kept talking about. Simplification.
Exactly. Their big theme. Become a simpler, more focused company.
Which is code for selling stuff, right?
Pretty much. Selling anything that isn't, core regulated utility assets. Pipes and wires, things that regulators approve and give them a return on.
And they made progress there.
Definitely. Big step this quarter was closing the sale of Pacific Current's solar and battery assets.
Pacific Current, that's their non-utility arm.
Right. Now, that sale did cause a little hit to EPS, about $5 million this quarter. Some accounting stuff, impairment, tax credit recapture. But the signal is clear. They're serious about shedding these non-core businesses.
And they're not stopping there. They talked about the bank stake again.
Reiterated the plan. Sell the remaining 9.9% stake in American Savings Bank, ASB, within the next year. Get all the capital focused squarely on the regulated utility.
So get out of banking, get out of non-regulated power generation.
That's the strategy. They're still reviewing what to do with the last Pacific Current piece, a biomass plant on Kauai. But the focus is already helping the parent company's numbers.
How so?
The core net loss at the holding company level, it was cut almost in half, down to $7.1 million compared to $15.5 million same time last year.
And that's mainly because they paid down some debt earlier.
Exactly. They retired $384 million in debt back in April. That directly cut the interest expense, dragging down the holding company results.
Okay, so simplifying, paying down debt,
Right.
that helps. But the real elephant in the room is the wildfire risk, isn't it?
Absolutely. And that's where the legislative side becomes so critical, Act 258.
Right, the bill the governor signed back in July, that's supposed to be the big fix.
It's the foundation for the fix, yeah.
Yeah.
It provides critical scaffolding, let's say, for managing this risk affordably. It fundamentally changes how future catastrophic risk gets priced.
Okay, break down Act 258 for us.
Yeah.
What are the key parts?
Two massive components that you really need to understand. First, it tackles the magnitude of future risk. It tells the Public Utilities Commission, the PUC, to set up an aggregate liability cap for future catastrophic wildfire damages.
A cap. So putting a ceiling on how much the utility could possibly owe in the future?
Exactly. That is a potential game changer. Instead of this unquantifiable kind of existential risk hanging over them, the idea is it becomes a measurable number, something you can actually plan around, maybe even insure or bond against.
That sounds good, but when does this cap actually get set?
Well, the timeline is vague. The law says as soon as practical. So the direction is clear, but the timing isn't nailed down yet.
As soon as practical. Investors probably don't love that uncertainty. What's the second piece of the act?
The second part addresses the cost risk. Act 258 specifically authorizes securitization.
Securitization. Okay, what does that mean in this context?
It allows the utility to issue special bonds backed by a dedicated charge on customer bills, specifically to pay for up to $500 million in wildfire safety upgrades and grid resilience investments.
And why is that better than just issuing regular company debt?
It's all about cost. Securitized bonds are typically very highly rated, often A-rated or better, because they have that dedicated repayment stream. That means a much lower interest rate compared to standard corporate bonds, especially for a company with HEI's current risk profile.
So cheaper borrowing translates to less impact on customer bills, makes the investments more palatable politically and regulatorily.
Precisely. It lowers the friction. It lets them make these crucial safety investments without causing massive rate shock. That's a huge regulatory win.
And the credit rating agencies are noticing this improved risk picture.
They are. Management made sure to highlight recent upgrades from Moody's, S&P, and Fitch. It definitely validates the legislative strategy.
That's positive momentum.
It is, but let's keep it in perspective. They're still quite a ways off from getting back to a full investment-grade rating across the board. The upgrades are good news, but the million-dollar question, or maybe billion-dollar question, is how much it actually lowers their borrowing costs for that big debt raise coming up.
Right, back to the financing question. That second settlement payment, analysts were really focused on that, weren't they?
Oh yeah, they hammered management on it. So the first payment for the Maui wildfire settlement, that's fixed at $479 million. It's due in early 2026, assuming the court gives final approval. And importantly, they already have that cash set aside. It's sitting there as restricted cash.
Okay, so payment one is covered. It's payment two that needs new money.
Exactly. That's the one they need to finance externally. Management confirmed the plan is to raise that capital at the holding company level at HEI.
How? Straight debt? Something else?
They said likely a mix. Straight debt and a possibly convertible debt. They're basically planning to re-lever the parent company balance sheet.
Re-levering the holding company.
Yeah.
And the timing for that raise.
They're targeting the first quarter of next year, Q1 2026.
So they're hoping the legislative clarity really sinks in. Maybe interest rates cooperate a bit by then before they have to go to market.
That seems to be the bet. Give Act 258 time to work, let the PUC process move forward, and hopefully execute the raise in a better environment.
Do they have enough cash to bridge until then?
They seem to think so. They reported about $374 million in available liquidity right now. That's combining what's left under their ATM program and their existing credit lines at the holding company, gives them some flexibility.
Okay, looking ahead then, what are the key dates or catalysts the market is watching now?
Two big ones coming up that will really shape the narrative. First, in November, management has promised to provide a new consolidated CapEx outlook and a rate base forecast.
Ah, the CapEx and rate base. That's crucial for valuing the utility, right? Shows the growth potential.
Exactly. Those are the hard numbers investors need to plug into their models for the new focused regulated AGI. Defines the earnings power.
And the second catalyst?
That comes a bit later, mid-January 2026. That's when the PUC is due to report back to the state legislature about potentially setting up a dedicated wildfire recovery fund.
Another piece enabled by Act 258.
Yes. The idea is this fund would provide a mechanism to handle future wildfire costs efficiently, further shielding the utility's finances.
So the big picture investment case is pretty clear. Pivot back to being a de-risked regulated utility. But the next year is all about nailing down the regulatory details and, crucially, the cost of that Q1 financing.
Got it. It's less about kilowatt hours sold in the short term and much more about regulatory outcomes and interest rates.
Okay, time for our quick segment. This is not financial advice.
Definitely not. Emphasize that. What follows is pure speculation, an idea sparked by the market dynamics we've been discussing. Analysis, not a recommendation.
Right, the core tension we've identified. You've got legislative progress potentially lowering long-term risk, but you've got high borrowing costs creating near-term pain and uncertainty. That creates volatility.
Especially around specific dates like that November CapEx update.
Exactly. So given that tension, here's an outrageous but plausible trade idea. Designed for someone looking to maybe monetize that timeline uncertainty.
Okay, lay it out. What's the structure?
It's a spread trade, or rather a covered position. You combine a short put option with a long position in a broad utility ETF.
Okay, get specific. Which puts? Which ETF?
The idea would be sell a decent-sized block of out-of-the-money HEI puts. Key is the expiration date. Make them expire right after that November CapEx and rate base update is expected. Why then?
Because you want to capture the high implied volatility, the fear premium, that's likely priced into those options leading up to that specific news event. You collect that premium up front, kind of offsetting the financing risk anxiety.
Okay, so you're betting the news might not be as bad as feared, or at least the uncertainty premium is too high. But selling puts is risky if the stock tanks. What's the hedge?
That's where the second leg comes in. You simultaneously take a modest long position in, say, XLU. That's the main utilities select sector SPDR fund.
Why XLU? Hedging against what?
Hedging against the possibility that the entire utility sector gets a boost. What if the market looks at Hawaii's Act 258, the liability cap, the securitization, and sees it as a successful blueprint for de-risking utilities facing wildfire threats elsewhere, like California?
So if AJ's legislative win lifts all utility boats, the long XLU position protects you somewhat.
Exactly. It acts as a partial insurance policy against a broad sector rally driven by recognition of this regulatory framework. Meanwhile, the short AGI puts aim to profit from the volatility specific to AGI's November catalyst and financing story.
Interesting. So you're trying to isolate and monetize the AGI-specific timeline risk while hedging some of the broader sector risk, a bet on regulation versus rates, essentially.
It's definitely an asymmetric way to play the situation. Highly tactical, depends on getting the timing and volatility assessment right. Again, not advice.
Absolutely not advice. Okay, let's wrap up. The main takeaway from AGI's Q2.
Core operations are holding steady. That's good. And the legislative wins with Act 258, the liability cap framework, the securitization tool, those are genuinely significant tailwinds for the long term.
But any race asked, the market isn't fully buying it yet. Still laser focused on the near-term execution risk, especially the cost of that big financing package needed for the second settlement payment and future CapEx.
That's the crux of it. Which leads to our final thought for you to ponder.
Go on.
Think about this. Management pulled off a major legislative victory with Act 258. That fundamentally addresses the magnitude of the future liability risk.
Right.
It puts potential boundaries around it.
Conceptually, yes, once the PUC sets the cap.
So the provocative question is, how much of the current risk premium baked into AGI stock price is actually still about the sheer size of the potential liability versus how much is now purely about the cost of capital, meaning simply what interest rate will they have to pay when they borrow that money in Q1 2026?
Interesting. Is the market more scared of the liability itself or just the interest rate environment when they have to finance it?
Because that cost of capital, driven by broader market rates, is the one big variable management really can't control between now and Q1.
Something to definitely chew on. That interplay between company-specific de-risking and macro-financial conditions.
Indeed. We definitely encourage you to keep exploring how that regulatory financial nexus is playing out, not just for AGI, but across the whole utility sector.
Great stuff. Thanks for joining us for this deep dive into AGI's Q2 earnings call.
And remember, as always, these are our interpretations of the call, definitely not financial advice.
We'll catch you next time on Talk Tickers.